At its core, car financing is about converting a large one-off purchase into a series of predictable payments over time. It plays a vital role in how cars are priced, sold, and managed across the automotive industry. However, financing is not just about affordability. It simultaneously prices three things: the value of the vehicle today, the value it's expected to retain in the future, known as the forecast residual value, and the cost and risk of lending money over time. Financing links the car itself to an agreement. This financial agreement sets how the car is paid for over time, who takes on the financial risk, and who earns money from the deal. It also determines when the value of the car is actually recovered, whether that's upfront, gradually through monthly payments, or at the end of the contract. In this way, financing shapes both the customer experience and the commercial outcome behind the sale. From a consumer perspective, financing answers a simple question: how much does this car cost me per month? However, from an industry perspective, it answers a more complex question: how do we balance volume, margin, residual values, and credit risk? So, why does financing exist in the first place? Well, for many consumers, tying up large amounts of money in a depreciating asset may not be a desirable financial decision. Financing solves this by spreading the cost over time and aligning payments with consumer income, usage, and expected vehicle depreciation. And for manufacturers and dealers, financing does something equally important. It can support consistent demand. Financing means customers decide whether they can afford a car based on the monthly payment, not the total price. When monthly payments feel manageable, customers may be more willing to buy. This can allow dealers to sell higher value vehicles, avoid sales declines, and have more influence over what models customers choose through finance offers instead of list price cuts. From a commercial standpoint, car financing is not a single rigid product. It's a framework made up of different structures that allocate risk in different ways. Some finance products prioritize ownership, where the customer ultimately buys the vehicle outright. Others prioritize usage, where the vehicle is returned at the end of the contract. In some cases, residual value risk sits with the lender. In others, it remains with the customer. These differences matter because residual values directly influence pricing competitiveness, profitability, and downstream used car market performance. Accurate residual value forecasting can support lower monthly payments and healthier margins. On the other hand, poor forecasting may lead to write-downs, stock imbalances, and value erosion later in the vehicle lifecycle. Ultimately, decisions made at the point of sale can have longer-term effects across the entire market. In most retail transactions, the finance product is sold by the dealer on behalf of a finance provider. This often happens at the same time the dealer acquires or funds the vehicle itself. These finance providers can take different forms. Some finance providers are captives, which means they are owned by vehicle manufacturers or dealer groups and exist primarily to support vehicle sales. They do this by offering tailored finance products linked to specific brands or retail networks. Others are independent finance houses, often backed by large banks, that provide funding across multiple brands and dealer groups. Together, these providers supply the funding that allows dealers to present finance agreements directly to customers at the point of sale. Once a customer has chosen a vehicle, the focus shifts into the design of the finance agreement. This part of the process is about turning the vehicle price into a specific, personalised offer. That offer defines how much the customer pays up front, how long they make payments for, how those payments are calculated, and what happens at the end of the agreement. It's also where additional elements are added to the deal, such as service plans, insurance products, or protections linked to the vehicle or the contract. This stage aims to bring everything together into a single agreement that meets lender requirements, complies with regulations, and can be clearly explained to the customer. Because this part of the process is often unfamiliar to customers, clarity is particularly important. The way the finance agreement is presented and explained can impact customer confidence, satisfaction, and long-term trust. So, car financing can influence which vehicles sell, how often customers return to dealerships, how brands manage residual values, and how risk is distributed across the automotive ecosystem. As vehicle prices rise and ownership models continue to evolve, financing is expected to play an increasingly important role in shaping automotive demand and profitability. Don't forget to visit the AutoVista24 YouTube channel and like and subscribe to stay up to date with all of our content, including our launch report series, webinar recordings, and our What Is Explainer series. Thanks very much for watching.